Hey everybody, my name's Allison Ostrander and I am the Director of Risk Tolerance here at Simpler Trading. And in today's video, I want to talk about some special cases, being mindful of risk in regards to the implications of dividends, mergers, and acquisitions on effect and how they affect options. So, first, let's start with the implications of dividends on options. When a company pays dividends, it can affect the price and value of options in several ways. And there's two different types that we'll focus on here: cash dividends and stock dividends. Cash dividends is if you hold call options on a stock and the underlying stock pays a cash dividend. Then what happens is the stock price may be reduced by the amount of dividend on the ex dividend date, which is usually you can find located on your chart so that you know it's coming up. And this can result in a corresponding decrease in the value of call options. Now, sometimes it can look like a significant decrease, other times it kind of seems like a non event. It kind of depends on the symbol you're trading. But it's certainly something to be mindful of with cash dividends when they occur. Now let's talk about stock dividends. Well, if a company issues stock dividends instead of cash dividends, it can dilute the ownership of existing shareholders, including if you are currently holding options on that symbol as well. And this may lead to adjustments in the terms of the options contracts, such as changes in strike prices or the number of shares represented by each contract. So, stock dividends, if you ever hold an option through it, you might find that you, let's say, jumped into a 250 strike level, and then all of a sudden a stock dividend happens. Maybe you weren't aware of it. And all of a sudden that 250 strike turns into a 230 strike, right? Just as a hypothetical. And so sometimes you just need to be mindful of how that is represented if you ever decide to hold options through a stock dividend. Now, of course, the easiest thing is to try and avoid trading around the dividends. If you have a setup that you really like, but you see a cash or stock dividend happening, you could either cut the trade early before that announcement occurs. And then if you want to, of course, always look to jump back in after the dividend happens, right after that date. So just be mindful of those, right? Because they can kind of change up maybe the value of the option that you're holding, or kind of change around the numbers and therefore maybe the strategy, depending on what you're looking at on the chart initially for the trade idea. Now let's talk about the implications of mergers on options, right? The combination of two or more companies. Once again, there are cash mergers and there are stock mergers. So, cash mergers, right? Some mergers involve a cash payout to shareholders of the acquired company. If you hold call options on the acquired company, the merger may result in the options being cashed out at a predetermined price or converted into options on the acquiring company stock. So sometimes when this happens, right, basically what this means in short is if you hold a long call and let's say, for example, Microsoft is looking to buy Activision, right? Well, if that goes through, they already have a predetermined price. Let's say it ends up being a cash merger where they completely take away, the Activision company. It gets absorbed into Microsoft, if you will. Then you might either get paid out in cash for that call option that you hold, especially if it's above the predetermined price that they're looking for, or it might get converted into Microsoft options, right? And so those are one of the two ways that can be affected. The other side of the mergers is stock mergers. And if the merger involves an exchange of stock, the terms of the options may be adjusted, such as a change once again in the strike price or the number of shares represented by each contract. The value of the options will be influenced by the relative prices of the stocks involved in the merger. So, once again, it might mean that you still hold your option, right, in the original company that you bought into before the merger happened, but it might change the strike price, or it might change technically how much shares that contract represents. Typically, an option share represents 100 shares equals one contract of an option. But whenever you're having to deal with a merger, that might be changed up some on that value. And so it's something to be very mindful of, especially in regards to a risk standpoint, to know once again, this, could happen to the trade idea that you're in. And then let's also now talk about the implications of acquisitions on options, right? When one company acquires another, then we have a cash acquisition and a stock acquisition. So let's talk about both of those. Cash acquisitions is if a company is acquired for cash. Options on the acquired company's stock may be cashed out at a predetermined price or once again converted into options on the acquiring company's stock. So once again, very same as a cash merger where if you're in a long call and that predetermined price is above your long call strike, then you might be cashed out, and that's given and placed back in your account, right, with that total value of what that trade was worth after the predetermined price and the cash acquisition happens. Other times, right, those options will be then converted into options on the company that's acquiring the company that you may hold. So, for example, purely hypothetical, let's say NVDA was acquiring Intel and you held options on Intel. I don't think that's going to happen, but let's just pretend it was, right? Well, then that Intel option you may have would either be cashed out or it would be converted into an option on the NVDA chart because they're the one acquiring Intel, right? Then we have stock acquisitions. If the acquisition is done through a stock swap, the terms of the options may be adjusted, such as, once again, changes in the strike prices or the numbers of shares represented by each contract. The value of the options will depend on the relative prices of the stocks involved. So similar to mergers, but once again, very something to be mindful of in regards to the capital risk you have out there and how overall the trade idea that you're in may change and adjust due to the action taken by the company acquiring the other one. And so, once again, that's just a brief overview of some of the things to be mindful about whenever dealing with dividends, mergers, or acquisitions within companies, because they do happen. The nice thing about dividends is you're usually given a date ahead of time and when that occurs. Mergers and acquisitions, of course, can, be news for the market to move on. So those can, sometimes feel like they're coming out of left field, which is why I would say it's always important that no matter what, when you jump into a trade, first control the initial capital risk you put out there, right? If you go into a trade idea with the thought process, I am okay losing 100% of the capital, then when these unexpected events maybe come about, you're still in control of that capital risk that you initially had out there. It might change the trade idea, but it might not necessarily, pull out more risk from your account or anything like that. That risk has already been identified. Thank you so much for joining me. As always, may the trade be with you, and I look forward to talking to you next time. Bye, guys.